I think there's that kind of potential in this market, and we get a real big bull market. We get, $5,000, $10,000, $20,000 gold, and those targets are not out of the question. I mean, I said gold went from 300 to 1900 in the decade from 01 to 2011. Gold went from $35 an ounce in 1970 to 800 in 1980. I mean, think about the magnitude of that increase. I think as investors start to realize that higher inflation numbers don't mean the Fed has to fight harder to win. It means the Fed has already lost and inflation has won. The Fed is very political. And so when it has to pick its poison, it would rather pick inflation. When the markets realize that that's where we're going, I think gold's going to be off to the race.
The continued weakness of the U.S. dollar continues to bolster the upward surge of the gold price, steadfastly maintaining its grip on the psychologically crucial resistance threshold of $2,000 per ounce. This trend indicates a potential upward trajectory leading into the end of 2023, as highlighted by recent trading activity. With a surge to an unprecedented $2,140 per ounce, the market stabilized around the resistance point of $2,053 per ounce during this analysis. Consequently, the bullish momentum in the gold market persists, propelled by the increasing inclination to bet against the U.S. dollar. This sentiment amplifies, especially after the abrupt shift signaled by the U.S. Federal Reserve, signaling the conclusion of its stringent monetary policy campaign. Renowned analyst Peter Schiff perceives substantial potential within this market, postulating the possibility of a significant bull market where gold might scale heights of $5,000, $10,000, or even $20,000. Despite reaching remarkable record highs, a swift plunge followed by a prompt recovery has established $2,000 as gold's new bedrock support level. This emergence signifies a bullish technical element, notably highlighting that the current support level was once an imposing resistance juncture. The Federal Reserve raised interest rates consistently over 2 years to curb high inflation. They held the policy rate at 5.25 to 5.5% for the third straight meeting, recognizing a slowing economy and reduced inflation pressures. They anticipate a future rate cut. The precious metal has shown strong resilience, despite concerns about rate hikes affecting gold negatively. Peter accentuates gold's performance amidst rising rates as an indicator of even greater potential when rates eventually decline. He foresees inflation rising, yet the Fed might not raise rates. Despite an inflation improvement below 3%, the government's control seems unrealistic due to high debt. He thinks the Fed might prioritize averting a financial crisis over fighting inflation, potentially boosting gold prices when investors realize this. We will present clips from Peter Schiff's interview with Commodity Culture. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
When gold hit that new record high, rather than just continuing to rise, we had a sharp drop. I mean, gold got to 2135, and the next day it was back below 2,000, or 2 days later. I think it got down to 19, maybe 75. So it had $150, $160 pullback almost immediately. But it quickly recovered. It didn't, go too far below 2,000, and it didn't stay there that long. So, I think that this is now the new support for gold, just around $2,000 an ounce. And that used to be the record high. So the fact that we've now are building support near what used to be massive resistance is a very bullish technical factor. And the fact that gold has held up this well in the face of some big headwinds, and these are headwinds that really shouldn't be there, but it's about perception. And the perception was that rate hikes were going to be very bearish for gold, that rising real interest rates, to the extent that they were real, but the markets believe that should have been bearish for gold. But we've now basically finished the tightening cycle, and gold is still at 2,000. So if gold did this well in an environment of rising rates, imagine how much better it's going to do when rates are falling. And the real environment that I think gold is going to flourish in is when inflation is accelerating, but the Fed is not matching that with rate hikes. And that's going to be a big wake-up call for investors, because I think what was, kind of keeping a lid on gold was the belief that the government, the Fed, was going to be vigilant and do whatever it takes to put that inflation genie back in the bottle and bring the rate back down to 2% and keep it there. And that's just a fantasy. That's not going to happen. And the markets haven't come to terms with that. And so in the past, or recent year or so, when worse than expected inflation news would come out, that would be bad for gold, even though it's good for gold because gold's an inflation hedge. And so if inflation's a bigger problem, there should be more demand for a hedge. But the way the markets reacted to the stronger than expected inflation data was just the belief that, okay, this means the Fed's going to have to fight harder to get rid of the inflation. That just means higher for longer. And that would hurt gold, and it would help the dollar. But I think as investors start to realize that higher inflation numbers don't mean the Fed has to fight harder to win. It means the Fed has already lost and inflation has won, because there's a limit to how hard the Fed can fight, given how much debt is in the system, especially how much debt the governments have and how much debt the banks are holding. And as much as the Fed would like to see lower inflation, they don't want to see a financial crisis. They don't want to force the U.S. government to default on its obligations. The Fed is very political. And so when it has to pick its poison, it would rather pick inflation than a financial crisis and just a collapse of the banking system and a sovereign debt crisis. So when the markets realize that that's where we're going, I think gold's going to be off to the races.
The recent surge in gold prices has raised concerns about potential market manipulation and highlighted a notable disparity between physical and paper gold markets. It emphasizes the importance of distinguishing between these markets to assess the actual value of gold and silver accurately. This spike in gold prices also highlights historical instances of gold's remarkable value increase, notably between 2001 and 2011, when it surged from under $300 per ounce to over $1,000. Peter acknowledges various factors that could influence gold prices, including motives to suppress its value, like profit-taking and short selling when it reaches new highs. However, he refrains from solely attributing the current price to manipulation. He notes a trend where less experienced investors tend to sell during market downturns, contrasting with the behavior of sophisticated investors and central banks who actively accumulate gold. Central banks, in particular, purchased a significant 399 tons of bullion in the third quarter, nearly doubling the previous record, as the World Gold Council reported. This accumulation reflects their anticipation of potential monetary crises within the fiat currency system. Let's get back to the interview.
I mean, in 2001, the price of gold was under $300 an ounce. And in a 10-year period to 2011, it went up to $1,900. So why didn't the manipulation stop that? I mean, how did gold go up so much if there was, people manipulating it? Obviously, it had a big move. Now, it should be even higher now, but that doesn't mean it's because of manipulation. But I do think that there's a lot of incentives, obviously, to keep the price of gold down. But there's a lot of big money that is selling gold. I mean, when gold hit a new high, there's a trading adage. I mean, it's not rocket science. Buy low and sell high. And, people took profits or took an opportunity to short. I think there is a lot of hot money that trades gold futures. And, when gold couldn't sustain the breakout, I mean, some selling came in. But we're going to exhaust this selling. I think that part of what's happening here in this bull market is that weaker players are being shaken out of the market. They're being discouraged by some of those sell-offs, and that's kind of what markets do. They try to get rid of a lot of the excess baggage, the dead weight, the weaker hands. They give up. But I think gold is being accumulated by sophisticated investors, by central banks. It's clear that we have a monetary crisis looming in the fiat world. And so people are accumulating gold. Central banks are accumulating gold. And we've had, a few false starts. And so when gold makes a new high, I think investors are still trained to sell into it, because every time it's made a new high, it's pulled back, and the people who sold made money, and they were able to buy back cheaper. But it's going to work until it stops working. And then I think that once the price of gold, breaks out, let's say we make the new high, let's say we get up to 2150 next time, and then they start to sell it, and they can't bring it down very much because new buying comes in and the price makes a new high. And, and the efforts to sell don't, produce a much lower price. That the buyers coming into the market are just taking up all that, the sales. And then at some point, it's the sellers that are going to throw in the towel. They're going to stop selling. And, when it comes to the paper markets, it's going to work both ways. A lot of people were shorting gold that didn't exist, that they didn't own through the futures market. And so that allowed selling to take place that might not have taken place without the futures market, because how do you sell what you don't own? But futures markets allow you to sell what you don't own. But I think that what ultimately is going to happen with those paper markets is the shorts are going to get caught, because I think once the market really has a big bid and it's hard to buy gold, I think a lot of the longs in the market are going to look to take physical delivery of their gold. And that's going to be a big problem for the shorts, because typically the contracts settle in cash. So the speculators who have shorted gold by selling futures, they never actually have to deliver any of the gold. But behind every gold futures contract, there's an obligation to deliver actual gold if the buyer wants it. But if the buyer doesn't want it, then you don't have to deliver. And generally, the people buying, don't need the gold, don't want the gold. They're just betting on the price.
Considering the blend of economic data, currency market trends, and Middle East tensions, the short-term outlook for gold remains bullish. The anticipation of U.S. rate cuts and ongoing global uncertainties continue to position gold as an attractive asset for investors. What are your insights regarding the future price fluctuations of gold? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.